All right, let's get right into it. Today, we're going to break down the anatomy of a stock surge that was, well, truly wild. We're looking at a company called Aqua Metals, ticker AQMS, and a price chart that honestly looks less like a stock and more like a rocket launch. So what on earth happened here? Let's dig into the data. So let's just start with a headline number, the one that makes your jaw drop, 383%. It's a staggering figure, the kind of thing that just makes you do a double take. But the real shock isn't just the number itself, it's how fast it all went down. And that's the kicker. This wasn't some slow and steady climb over months or years. Nope. This was a full-blown explosion that happened in just two trading days. That's a life-changing amount of money for some people, and it happened in the blink of an eye. And that, of course, brings us to the big question, right? When you see a move this massive, this fast, are you looking at the start of the next huge thing, or are you staring at a giant flashing red flag? Well, the technical data gives us some really fascinating clues. Okay, first things first, let's actually trace the flight path of this rocket ship. Because to really understand the sheer velocity of this move, you have to look at the timeline day by day. So check this out. For most of September, AQMS is just a quiet stock. Bouncing around below $5. Then, boom, on the 24th, you see the first little spark. But the real fireworks, that's between October 9th and the 14th. The price just goes parabolic. I mean, it hits an absolutely insane high of nearly $40 during the day before pulling back pretty hard to close just under $30. But even with that big pullback, the gain was just astronomical. An explosion like that, it doesn't happen in a vacuum, It leaves behind this trail of data, like breadcrumbs. So now we're going to put on our detective hats and start reading the warning signs that were hidden right there in the charts. Clue number one is the trading volume. It's just staggering. On a normal day, this thing was sleepy. Fewer than 200,000 shares would trade hands. But at the peak of this frenzy, that number rocketed to over 34 million shares. That tells you that some big money got involved, but it can also be a huge signal of exhaustion, kind of like a sprinter who just burned every last bit of energy in one final desperate burst for the finish line. So here's our first big technical clue, the RSI, or Relative Strength Index. The easiest way to think of it is like a speedometer for a stock's momentum. Anything over 70 is considered overbought. You're basically redlining the engine. Well, AQMS hit almost 90. This indicator is just screaming a warning, telling you the buying frenzy has gone way too far, way too fast, and the stock is running dangerously hot. And believe it or not, the story gets even more extreme with our next indicator, the money flow index. It's kind of like the RSI, but it also folds in that insane trading volume we just talked about. Here, a reading over 80 is the warning zone. AQMS hit 98.8 out of a possible 100. I mean, that's like a pressure gauge being pushed to its absolute breaking point. It's basically confirming that the buying pressure was at a completely unsustainable level. And hey, if you had any doubt left, just look at the CCI, the Commodity Channel Index. On this scale, a reading over 100 is usually considered extreme. AQMS didn't just pass 100. It registered a mind-boggling 573. So you see, it's not just one indicator flashing yellow. It's a whole chorus of data points all screaming the exact same thing. Red alert. Okay, so we've got all these clues, and they're all pointing in the exact same direction. When you put them all together, they lead to a really clear diagnosis from a technical analysis perspective. The stock is what we call overextended. So what does overextended actually mean? Well, think of it this way. Every stock has an average price it likes to hang around. It's like its center of gravity. An overextended condition happens when the price just shoots up so incredibly fast that it leaves that average completely in the dust. It's a huge sign that the move is just too fast to be sustainable. And this is seriously the perfect analogy for it. The stock's average price, that's the rubber band just sitting there, at rest. This parabolic surge, that's someone stretching that band to its absolute limit. And we all know what happens when you stretch a rubber band that far, right? The snapback, which in trading we call mean reversion, becomes almost inevitable. And this isn't just a feeling, right? We can actually put a hard number on how far that rubber band has been stretched. A linear regression analysis shows that the stock closed 227% above where its statistical trend predicted it should be. That is just an extreme deviation that screams vulnerability. All right, so we've analyzed the past, we've diagnosed the present situation. Now, what does all this data suggest might happen next? Well, the analysis lays out 4 potential paths forward for AQMS. According to the analysis, the highest probability, by a long shot, is a continued correction. That's the rubber band snapping back. That's at 60%. The next most likely outcome, at 30%, is consolidation, where the price just kind of trades sideways for a while to digest this huge move. And the chance of the rally just picking right back up? Only about 10%. So for anyone watching this stock, these price levels are basically the key battle lines. Think of support levels like a floor, where buyers tend to step in and stop the price from falling. Resistance is the opposite. It's a ceiling, where sellers usually show up. The fight between buyers and sellers at these exact spots is going to determine what happens next. So, after sifting through all this data, the insane surge, the crazy volume, all those overbought indicators, what is the final takeaway here? What's the bottom line from the analysis? And there you have it, stated as plainly as possible. The analysis basically concludes that the risk versus the reward, it's just not good. The potential pain of that rubber band snapping back is now a lot bigger than the potential gain of it stretching any further. It's a pretty clear warning against chasing a rally this extreme. And, this all leaves us with a much bigger question. The story of AQMS is just one case study, but the lesson here is universal. Whether we're talking about a stock, a crypto coin, or any asset that goes completely parabolic, the challenge is always the same. How do you figure out where that razor-thin line is between a true revolution in value and a speculative bubble that's just waiting to pop?